All right, guys, welcome back to this lesson. And in this lesson, we're going to be covering trading catalyst and Twitter hype. We kind of did that a little bit in review here of one particular play, DCGD. The amount of Twitter hype this play has created. I wish I could block a ticker on Twitter so I don't see so many DCGD posts. But learn to judge what you see on social media to determine your play. But I'll go ahead and get started. Do you need help in deciding when to take action in the market, determine which trading catalyst, trend trading, counter trend trading, or chart pattern based trading might best fit your trading style? Each time a trader decides to enter into a new trade, there is some underlying reason that causes him or her to take that particular action at that particular moment in time. We've referred to this reason as a catalyst. A trading catalyst can be thought of as a single or multiple set of criteria that triggers a trader to take action. The universe of potential trade catalysts is vast, and at times it seems as if no two traders rely on exactly the same set of criteria to tell them when to enter a new trade. In a sense, this is what makes markets. In other words, if a traders relied on the same catalyst to tell them when to trade, there would be no one to take the other side of the trade. So a vast network of traders utilizing as many different trading catalysts as possible is ideal for creating liquid markets. We all have these different styles. I'm more of a catalyst trader. I'm going to be watching my news scanner for filings, for anything associated to something that would perk my interest for a play, and obviously to see, how low on this chart I'm actually entering and not being involved with a sell on the news type of scenario. So, different style of trading. The majority of traders tend to rely on one or more of three primary categories of trade catalysts. Trend trading involves analyzing technical and or fundamental factors to determine the current dominant trend for a given stock or other asset, and then trading in the direction of that trend. Once a trend following trader feels confident that the current trend for a given stock or other asset is up, they will look to buy in hopes of profiting from a continued price advance. Counter trend trading involves analyzing technical and or fundamental factors to identify the current trend for a given stock or other asset, and then trading in the opposite direction, known as short selling of that trend. In some cases, this may involve trading against the dominant trend, while more commonly it involves trading shorter term pullbacks within the dominant trend. So, you've seen this play go up massively. Obviously, this is more in big boards than OTC as far as retail short selling. But in this scenario, you've got a massive run up, and people are watching this massive run up to determine a top or, a good peak area to start borrowing some shares from their broker to sell short, which is pretty much shorting the stock in the hopes of it, falling down or crashing down or selling off. So it becomes, just depends what becomes the more dominant trend. If you're a short seller, if you're, a trend trading long. And of course, you got chart pattern-based trading involves looking for particular patterns to form on a price chart. For example, a double bottom for bullish traders or a double top for bearish traders. This type of analyst typically involves a drawing, extending lines across the chart of previous price action and looking for either a particular pattern to form or for a price to break out above particular lines as a trigger to take action. Okay, and as new traders, you guys are very hesitant. Let's say you've had a bad history of buying bad trades, and you're hesitant. So you've got to come down to those pros and cons that trigger you as a trader to take the trade. No money, scared money don't make no money is the way to look at it. So learning your style of trading, are you more inclined to say, oh, this catalyst speaks like it's really good, but you're not checking the chart and you're chasing the play because this catalyst just tells you buy written all over it. If you had if you had your scanner tell you every single news source says buy on it, instead of giving a description of the news source and just said buy or not to buy, how much simpler would that make it for you guys? I mean, you got to understand these catalysts. You've got to read through them and understand what triggers the buy method in your brain versus the don't buy method in your brain. And of course, share structure, knowing the potential that this play can move on easily with whatever catalyst it is. It's putting all the factors into one area in your brain. And to me, it's all come to memory. But you guys, you got to have your written down share structure. Does this play fall in line with my share structure ID? Does this news look like it has potential to grow? And putting all that together in your trading plan to execute or act upon that trade. Each of the above catalyst categories offers pros and cons. Answering the following questions can help in determining which catalyst best fits your trading style. Which indicators do you use to identify the trend? What is your trading time frame? Long-term, intermediate term, short-term, or indefinite? When to actually enter into a trade once the trend is designated bullish or bearish? How to determine if the trend has reversed? When will you consider taking a profit if the trend is still moving in the right direction? When should I cut a loss? Having answers to these questions can help a trader maximize the effectiveness of the trading strategy. Like I was just talking in the review earlier, take some profit off the table after you're up, especially if you're up 100%. It's the most common thing us OTC traders talk about, that if you're up 100%, go ahead and sell half of your position. I mean, I don't expect you to put it all up on the ask at one block if it's a massive amount. Scale out, learn the 30-30-40 rule, in the sense where, you're putting 30% up on the ask of your position. Um, it could be in several different price increments. It could be in one price increment. It just depends how big your position is, obviously. But put 30% off, on the ask of your amounted position when your stock is up 30%, and then put up another 30% after you're up an additional 30% or 60% overall, and so on. And then obviously the last 40% you can put up when you're actually at 100% and you've scaled out half of your position. I do have a calculator in the chat room for that. It's going to be under elites right here under calculator. Online calculator, yeah, that's averaging calculator. This right here is the 30-30-40 rule, where we have so many number of shares. Let's say we've got 100,000 shares of something, and you've got an average price of 0.02. And obviously this calculates that, we got 30% at 30% profit. We put 30,000 shares for sale on the ask at 0.0026 for $60 cost. Obviously this is a very tiny trade in regards. Maybe we need to step this up so it's a little more realistic. But in a sense, you got 30% at 30% for 15 or 150,000 shares on the ask at 0.0026 at a $300 cost. That gives you $90 profits on that trade. And then another 30% at 50% profit, which is another 150,000 shares at 0.0030. And then you've made another $150 profit on your cost. And then you can let that other 40% when you're up 100% for a remaining 200,000 shares, or your freebie, so to speak, for $400 profit. And you've literally invested $1,000 and have made $640 off your $1,000. So you can do that sense. It's scaling out in a sense. It's more protective of your capital. It's easy to do because most plays kind of run this way in OTC, where you're scaling out as the play is trending upwards. So use that calculator. It's for you guys in the elite section right here under calculators. So, keep that in mind. Use the scale out method. It becomes your trading plan, and, scale out your play properly. Trend trading as a catalyst. Many traders who rely on trend following techniques as a catalyst for identifying trading opportunities have come to realize that picking tops and bottoms with any sort of accuracy is a very difficult task. In many cases, they have also learned the benefit of heeding the old adage. The trend is your friend. A trend following bullish traders essentially gives up the goal of buying low and selling high, and instead attempts to buy high and sell higher if bullish, and sell low and buy back lower if bearish. The primary advantage of using trend following as a trending catalyst is that it affords traders the opportunity to ride price action at times and does not always involve the need to precise timing. The primary disadvantage of using trend following as a trending catalyst is that a trader often foregoes a certain amount of profit potential while waiting for an identifiable trend to develop. Counter trend trading as a catalyst. Traders who rely on counter trend trading techniques use a catalyst for identifying bullish trading opportunities as typically willing to take a more aggressive approach to trading than traders who rely on trend following techniques. To rely on a counter trend technique as a catalyst, a trader must have great confidence that the technique will come reasonably close to identifying a turning point in price action. Otherwise, the trader may be faced with the need to realize a loss before the desired price reversal occurs. Buying a stock in the face of price decline is essentially referred to as derisively as trying to catch a falling knife. There is clearly an element of risk involved, the same as due of selling short a stock in the face of meaningful price advance. So kind of like, our DCGD endeavor here, where we got literally almost a falling knife in a sense. As a trend trader, you're going to be like, okay, support is, 182, that 182's got a hold. I'm going to put a bid there. All of a sudden, it's crashing, crashing, crashing. You've got to kill that loss instantly. It's hit your risk. You obviously want to get in this trade as a trend trader to where you have upside potential, more upside potential than downside potential. After this is broke support, this shows you all the downside potential you have over the upside potential you could have. So obviously a very risky trade, trying to buy that support range here when this, when it's hit 182s, 180s, it looks like, and obviously broke it. So obviously not a smart trade because they're thinking, okay, 180s to 220s, maybe, over $2, it could break out. Who knows? But in this sense, it broke that support and obviously cut loss instantly instead of riding this thing back to having a bag in your account. Literally, that's what this has created for so many people. It's sad to say, massive bag. Hopefully lessons learned in that trade. Chart pattern-based trading fits into the realm of research known as technical analysis. Traders who rely on chart patterns as a catalyst for finding trading opportunities spend their time pursuing price charts, looking for certain patterns of price action to develop as a potential sign of future price direction. It should be noted that most chart patterns fit into the trend following or counter trend categories, as some patterns suggest a continuation of an ongoing trend, while others portend an immediate reversal in price. Still, because of their unique nature and the fact that many traders rely on chart patterns as standalone techniques, chart pattern trading is considered by most as a separate category of trading catalysts. The primary advantage of using chart patterns as a trading catalyst is that it's another tool a trader can use by itself or in conjunction with other indicators to help identify potential changes in price direction. The primary disadvantage is that it can involve a significant amount of subjective analysis of the trader's part. Also, while particular chart patterns may seem obvious in hindsight, identifying in real time and actually pulling the trigger to make a trade can be more challenging in many traders. I've got a trade in mind, HMLA. We played this one a while back. I think it was last week or the week before. This play was pretty impressive, okay? It's been trading this. It's been on my watch list constantly. I've been waiting for this breakout area to kind of start. Obviously, it did start a little bit. No, let's see. That is when we started. I watched it spike up this morning. I think that was August. This was back in August things. And I don't think I got into this play until we hit here. So it was constantly on my watch list because of that spike. And I know a lot of people had still interest in it. I noticed some volume hitting the scanner a lot around that morning. Or actually, this is the day before. Yeah, this is September 3rd when I got in. And I noticed it hit a lot of volume, so it kind of empted me that this could be a good play for the following Monday, because this was obviously a Friday, and then August 30th to September 3rd. So it gave me some umption that, a lot of volume into close here, the last half or whatever of Friday, nearing that penny range could make a good potential run for Monday. So you got to watch those, good high of day closes, so to speak, to find out if it's a continuation. So anyway, this play, as soon as it broke a penny, right away I was like, okay, this is ready to break out penny territory. And it's something I love. It's something I'm used to trading is penny breakouts. I love a good penny breakout. It seems like every time that play is bumped against that penny, is broke against that penny, it always triggers a breakout. Okay, you got to realize there's traders like Timothy Sykes and his group don't touch anything unless it's a penny plus. Okay, it's a whole new group of traders that get attracted to plays that break that penny and actually hold that penny breakout. So I alerted the crew. I think it was around 0095 or one-ish. This looked like a good potential runner for the day, and there was no catalyst. But we got into the play, because I felt the risk versus reward was pretty high at this point. It broke out that penny, and it continued to trend up very nicely, almost hitting 2 cents here and back down. And all of a sudden, some rumor comes out in the middle of the day. This is 12:30. It looks like right here. That Costello is buying in this play. And we all know the whole rip-a-maroor that's floating around, Twitter and iHub, that Costello is just the big hoochie mama here that can make anything run. But Costello's buying into this play, and there's this little email floating around that, yeah, he's adding into it. everybody's buying into this hype. And I was like, okay, well, I'm holding my position because I feel like that could lead to it in an excess amount of breakout. What do you know? It did. It broke out here. It rested here. I sold a little early. I scaled out half my position here about this 250 range, 230s from my 0095 ad. I went and scaled out right here, and I was on freebies. I was pretty much going to cut my area here after this one area because I felt like this may be the end of our play. But what do you know? 12:30 rolls around, news comes out of a rumor, I should say, of some tweeting of this email that Costello's buying, and what do you know? Everybody buys anything Costello touches. So anyway, it ran up here. I sold half my position here. The trend continued to go up, and it started spiking massively. As we start seeing these candles, it broke that high that it hit right there at 0026 or 0269. It broke it here in a full candle and continued up, and I scaled out in my final around 3 cents because I felt like we've already hit some good steps, and I'm going to take my profits and run. Well, anyway, I think just stopping by, our several guys in the chat continued to hold half their position, and I think just stopping by actually sold right around the 4 cent mark. Perfect trade on his part. Obviously, I took profits too soon, but you never can be too careful of this because the catalyst led me to play it continually from my position of getting in early to feed off that hype. But that does not mean if Costello's buying it, this is going to do a DCGD move now, does it? Oh, wow, it's at 4 cents. This could hit 50 cents. It could hit $1. Hell, it could hit $300. We're not thinking that scenario. We're trading the trade. We're feeding what the volume can give us. The higher it goes, the more realistic and skepticism you've got to put to your trading plan to take the profits. Golden opportunities don't come by often. How many times do you get into a play that runs 200% plus here, like this did that day? I mean, it's awesome trade, good money made. Got to take those profits because, as you see here, came back down to the 2 range here, bounced up the next day to the 4 range again, and kind of traded sideways for the most part. And I think it hit, it did hit 5 here a while later. It did get some back massive volume here after it hit that 2.5 range again, and actually went straight up to 5s and is kind of downtrending since then. And of course, this crashed, I think, the same Thursday, September 12th, during the whole Costello, fiasco with DCGD. Because his plays literally play in its own sector, as you will. So that kind of covers that area. So what are stock catalysts? A stock catalyst, also called a news catalyst or just a catalyst, is a development that has the potential to move the price of a stock. That's broad, right? Let's get specific. Often it's in news related to a company or industry. However, sometimes catalysts can be less direct, like government regulations that can affect an entire industry or sector. This isn't something you can brush off as a trader, so pay attention. It's important. A catalyst can help you find the sweet spot for entering a trade that can be before the stock price hits its highs or lows of short selling. Here's an example of some common stock catalysts. World events, okay? Thinking of a world event, the airstrikes going on in the mid east countries or whatever it is going on over there, blowing up some oil wells, okay? I think it's Saudi Arabia. Blowing up some oil wells, so obviously that's a world event going to cause some oil stocks to probably pop tomorrow because the demand is going to increase since the supply is so minimal now. Sometimes something that's reported in the news can act as a catalyst to move stock prices up or down. Think back to last year when Canada officially legalized marijuana. That was a huge catalyst that rocketed the entire sector of marijuana-related stocks. Select traders made fortunes in record time by trading in this sector thanks to the heightened interest and speculation around weed stocks. Okay, fall is when weed is harvested. So we're obviously going to probably have some weed stocks pop this year too. Maybe not to the extent that it is last year because the regulations were waiting on the farm bill to pass this past spring. So we don't have that scenario in a sense, but I know there is more states that have not legalized it yet. Yeah, it was in big news, but traders also saw it as a sign of changing times. Suddenly, everyone wanted to get in on the ground floor with pot stocks. As a result, the prices soared through the roof. That's a good example of a catalyst that made stock prices explode. But it's important to note that a catalyst can act in the reverse way too. Bad news that's connected to a sector or stock can have a negative effect on stock prices. Company news. Sometimes the news that rocks a stock price is specific to one company. Now, I'll give you an example of bad news. Let's just say there was $1 million order of Apple phones or something that went bad and they have to recall every single one of them. Obviously, that's not good news for Apple. You're going to see Apple stock plummet because of that. So that's an idea of news. And in this sense, you see the oil supply crashing, but there's actually a real world demand for oil. So then, in a sense, that's going to spike oil companies because they're limited to a certain, amount. So something to think about. Company news. Sometimes the news that rocks the stock price is specific to one company rather than the entire sector. A good example here is a tech company like Apple. In this case, you're looking for anything that may be significant, maybe a major product launch or an announcement of an updated iPhone with incredible new features. These things can move stock prices in a way. Okay, the newfangled iPhone 11 has just landed. I didn't know about it. My wife all of a sudden announces it to me today. She's ready to get this new iPhone 11. So anyway, that could probably spike up the Apple, in Apple stock in the sense that they're launching this new phone. All of a sudden, new demand of money is flowing in. Earnings winners and losers. If you want to be self-sufficient trader, you have to do research on every single trade. That means you need to review earnings reports for any stock you're watching. Public companies are obligated to release their earnings on a quarterly basis, usually not long after each quarter ends. There are certain expectations or projections for companies' earnings each quarter. If a company misses or beats those expectations, guess what? That can propel the stock price in motion. A company's performance report can kick off a stock's uptrend or downtrend if the company meets or exceeds expectations. That can generate optimism and excitement in traders, and that can boost the stock price. Buyers catch wind of the positive earnings news and rush to jump on the action. Breakouts abound. However, if a stock underperforms and the company can't specifically account for its lackluster performance, guess what? The stock price can decline. Earnings reports can be fairly reliable catalysts. Don't overlook them. This is generally for big boards as we're talking on these catalysts. New deals. Did a company sign a new big contract or forge a partnership with an industry leader? New business connections can generate trends in stock price. For example, when music streaming service Pandora announced partnership with AT&T and Snapchat, it contributed to an increase in the stock price, raising it almost 20%, which is huge for big boards. Make this part of your research routine. Scan regularly for updates on new partnerships, deals, and contracts. They can all influence stock prices, and the sooner you see the news, the sooner you can act. You don't want to be the guy that catches the news at the end of the day and it's like, oh, hey, did you guys hear about this? Blah, blah, blah. I'm like, yeah, we knew about it this morning. We done played the run off that news, and we're good to go. Done flipped the trade and made our money. And they're like, damn. I think we did have one guy in the chat room that always posts the news literally at the end of the day. I forget what his name was, but it's a new mistake. It's common to get. If you're late to the news, then you've got to understand when this news came out. You've got to be early to that news, be before it, be able to catch in. And even reading through filings, you're going to read through some of the 8Ks, Form 4s, anything that triggers a potential catalyst within the news source. You're going to kind of dig through it and see potential. That's kind of how I found PCTL. I dug through an 8K that they dropped, and everybody was kind of quiet about it when it opened up the next day. And all of a sudden, we were early. We got in good price, and the catalyst spoke volumes. And what do you know? That play made a nice, 300, 400+% run. So awesome. It was in early. We read the catalyst, and we understood what we were dealing with. Hires and fires. If a company is experiencing changes in management time and time again, shifts in personnel and management prove to be catalysts for stock prices changes. Just Google a CEO steps down, stock plummets, and you will see countless results where the stock price plummeted after a CEO resigned, especially under favorable circumstances. Here's just one example. The CEO of the tech company Micro Focus left after just 6 months of the job and dragged stock prices down a staggering 40%. Now, that's a whopper. Note that depending on the circumstances, the price shift can be more or less, of course. It's possible for this phenomenon to work in the opposite direction, too. Maybe a company hires a high-profile visionary employee. If they make a revolutionary strides and catch the attention of the press, it can create optimism that raises the stock price. Underlining optimism in this sense here. You've got to create that optimism for traders to assume or speculate. Benefits of stock catalysts. Why look to stock catalysts to win trading? Here are some of the reasons. That's where I come in. Okay, I trade my stocks off of catalysts. I don't trade them off of chart trends per se, unless it's really at a 52-week low and I'm expecting some possible catalysts for that play. I'll get in, but for the most part, I'm obviously following the news, trying to get early to the news, understanding the next phase of events, kind of like our PFMS play. We're in early. We know what's coming next. So in that sense, we're following the news and being early to that area. Why look to stock catalysts to win trading? Here are some of the reasons. Spot trends early. One of the biggest benefits of stock catalysts is that if you catch them early, they can help you spot market trends before they happen. This isn't a no-brainer. You have to think critically to figure out which stocks might be affected. Predictable patterns. Once certain stock catalysts occur, patterns often follow. A CEO stepping down can frequently yank the stock price down. A positive earnings report can often drive the stock price up. Nothing in particular in the market is over 100% guaranteed, but events like these occur enough to where they can be considered reliable patterns. Support your technical research. As the students in my trading challenge know very well, I rely most heavily on charts and technical analysis when choosing my trades. However, looking at stock catalysts can help me determine the timing and decide when to make a move. I think they're extremely important. That said, you should never make a decision to trade solely based on the stock catalyst. You should always conduct technical research on every single stock, but a catalyst can help you build a case to trade a stock, pushing you to a buy or sell territory. Technical research and stock catalysts work hard hand in hand when making trading decisions. Okay, just take this for example. What if you followed some guy on Twitter? He posted some news or some kind of rumor, and you jumped to the conclusion that this was solid, this was evident, and you're going to jump into this play no matter what because he's called a couple good winners in his lifetime career, and you jump to that conclusion without doing any chart analysis of where has this play gone to. Are you buying the top of a trend? Are you buying the low of a trend? How much preload are you in before this? And so on. You get stuck for not doing enough research to jump in quickly. You've got to understand research, due diligence, be quick about it, and you can jump in with these catalysts. Identify anomalies. Stock catalysts can help you figure out if there's an anomaly that alters the stock price in the way that breaks a pattern. For example, if you look at a stock's chart and see that 3 months ago it jumped up in price, that's a cue to dig deeper. So maybe you look back and find that's when they signed a new contract. You can probably assume that's when they moved the stock price. That type of spike is an anomaly. So you can dismiss it when trying to identify a pattern because it's unlikely to occur again. Okay, Twitter movement. This is where Twitter can literally move a stock, okay? Even chat rooms can move a stock. Now we don't want to get hung up on using Twitter as a catalyst on its own, but a stock that has a lot of mentions on Twitter can see nice movement. Of course, there's usually other catalysts behind those Twitter mentions as well. It can be useful information using Twitter accounts to your advantage. It's like having another set of eyes on the market with similar plays in common. Learn to follow a group of people that play the plays that you do. They kind of have the same style as you do, and they're not literally just pumping the daylights out of every play they're on. I look at it as an assembling my Twitter tweeting team. Use it as a scanner, subscribe to their tweets, and boom, I got a team member working for me. How to find these team members? I randomly search the hottest tickers on Twitter. I start noticing familiar faces putting content out. Their tweets were early before the run started. I never trust a tweet no matter what, but I use it to my advantage as a potential play idea. I do my own research before pouncing on the play. Okay, use that hugely. Do not pounce on the play just because some Twitter guy is pumping a tweet on a play. Do your own due diligence, understand the share structure, what's the catalyst, how early are you in the play. Write this stuff down. Learn to create that trading strategy, that trading plan to understand these catalysts and not be the one buying the top of a play, not the one buying shares off of a chat room or Twitter pumping on this play. Be reasonable that why you're buying this play and understand why you're buying this play. Summary. One of the most important decisions any trader can make is deciding what specific criteria will cause them to take action in the market. The good news is that there are many choices available. In any cases, a trader can alter the standard interpretation of a given catalyst to create their own custom trading trigger. The most important part of this endeavor for each trader is to develop a set of criteria that they are comfortable with, confident in, which can be reused on a regular basis. So you're not scared. You know, you're scared money is not making money. You're actually using your money to make money, and triggering yourself according to a set plan, not just a random at will trigger to buy, trigger to sell, trigger to buy, trigger to sell. You've got a guideline of why you're buying each one of your plays. Don't force your plays. You know, we're dealing with summer volume sometimes here and there. This past 2 weeks have been a little bit slow. There's been very few, lot less plays than there has been in the past. So I don't force a play. I'm looking for that A+ setup that meets my trading criteria, so to speak. So anyway, guys, I hope that answers some questions in the catalyst and trading plan kind of department. I'm going to go ahead and end the class there, and I'll open the mic up for questions.